Most traders rush into the market as if the tape were running away from them, and they fear they'll be left behind. But if you've studied the market as long as I have, you already know there is no need to chase anything. Prices will come to you if you understand the behavior of the crowd. And that is why today's topic naturally follows the ideas we explored in the previous video on Richard Wyckoff, patience vs. impulse, the trader's real battle, because nothing tests your patience more than watching a market run upward and resisting the urge to buy right at the top. Now let us settle into today's lesson. When I say, stop buying the high, I am not scolding you. I'm reminding you of a law of markets older than all of us. Professionals sell into strength, while the public buys into strength. And do you know why that is? Because the public sees higher prices and assumes they must accelerate forever, while the professional recognizes the footprints of distribution, the subtle volume shifts that tell you the smart money is handing the stock off to eager latecomers. Have you ever felt that uneasy sensation right after buying the breakout, that maybe you were just a little too late? That feeling wasn't fear, it was your intuition detecting distribution. You see, distribution is rarely loud. It doesn't scream, it whispers. And if you train your eye to read volume as I did when I studied the great operators of my era, you'll begin to sense when the character of the market changes. Today I'll walk you through 5 volume signals of distribution, signals that, once you recognize them, might save you from repeatedly buying at the top. But let's take our time. That's how trading works best. Calm, measured, observant. No haste, no drama. Just reading the tape. Tell me, have you ever slowed down long enough to ask the market what it is really doing? The first volume signal is the appearance of climactic volume at the highs, but without genuine follow-through. The public sees the tall bars and thinks, strength. But the tape reader understands the difference between aggressive demand and the exhaustion of a move. When a stock pushes upward on expanding volume, but closes off its high, that is the professional selling into your enthusiasm. It's like watching a runner sprint the final meters only to stumble at the finish line. If you've ever wondered why strong moves die just when they look unstoppable, this is often the reason. The second signal is the emergence of wide spreads upward accompanied by disproportionately heavy volume, yet producing very little net progress. Now ask yourself, what sort of buying produces large volume without lifting price very far? Not eager demand. No, it's the unloading of supply. The composite operator uses the public's excitement to distribute large blocks quietly. I've watched this unfold hundreds of times across decades of tapes. And you? Have you ever noticed how some rallies feel strangely heavy, as if weighed down by invisible hands? The third signal is something many traders overlook. Decreasing upward progress despite increasing volume. This is a subtle one. The market appears lively, active, full of interest. But if you watch the bars, you'll see each push upward traveling a shorter and shorter distance. It's as though demand is growing tired. If this reminds you of our conversation on controlling impulses, it should, because the same mental discipline that keeps you from acting too quickly also helps you observe these slow changes in a market's character. In the previous video, Richard Wyckoff, patience vs. impulse, the trader's real battle, we explored how restraint reveals what others overlook. Here, that restraint allows you to see that volume and progress are no longer aligned. The fourth signal is heavy volume on minor rallies during a range, especially after a preliminary sign of weakness. Think of this as the marketplace breathing heavily when it should be breathing easily. A healthy uptrend rallies lightly and naturally, but when each small upward movement requires more and more volume, it's a clue that supply is ready to pounce. Professionals are distributing, not accumulating, even if the range looks deceptively calm. Have you ever watched a stock trade sideways and wondered why it just couldn't lift, no matter how many buyers seemed to show up? The fifth and final signal we'll discuss today is the upthrust. That moment when price jumps above resistance, volume swells, the public buys aggressively, and then the market snaps back into the range. To the untrained eye, it looks like a failed breakout. But to the Wyckoff trader, it's the fingerprint of distribution. The composite operator just tested how many buyers were left, and after discovering plenty, he used the breakout to sell to them. This is one of the clearest indications that supply is dominant. And tell me honestly, how many times have you bought that exact breakout? Now, if all of this sounds like a lot to track, remember that trading is the study of behavior, yours and the market's. Think of wealth building not as a sudden leap, but as a patient process of understanding how professionals operate. The crowd buys excitement, the professional sells into it. The crowd fears declines, the professional prepares for opportunity. And every one of these volume signals is simply a conversation between those two forces. When you see volume swelling near the highs, when the spread widens but progress shrinks, when rallies demand too much effort, or when breakouts fail suddenly, these are not accidents. They are signals. Signals that supply is active. Signals that the composite operator is preparing for the next phase. Signals that you as a trader must exercise the patience we spoke about before rather than giving in to the impulse to chase. Climactic volume near the highs can deceive nearly every inexperienced trader because, on the surface, it looks like the strongest moment in the entire move. The bars grow taller, the candles stretch upward, and the price seems to accelerate with a kind of urgency that feels irresistible. Most people look at this surge and assume it must be genuine demand, something powerful and unstoppable. But in reality, this kind of activity often represents the exact opposite. In the Wyckoff method, such climactic behavior is frequently a sign that professional interests, the composite operator, are completing their selling, not initiating fresh buying. And once you understand why, the whole picture of market behavior begins to shift. When a stock or crypto or index has been trending upward for some time, an accumulation of public interest slowly builds behind it. The public, however, usually enters late. They are slow to believe in the trend during the early phases when smart money quietly accumulates at lower prices. But once the trend becomes obvious, once financial media, social platforms, and excited traders amplify the narrative, the public begins to buy with confidence. By the time excitement reaches its peak, the composite operator has already been distributing for a while, handing off shares to latecomers who have finally decided the move must continue higher. This is the true nature of climactic volume at the highs. The professionals know that to unload large positions efficiently, they must do so during moments of enthusiasm, not moments of fear. Selling during weakness depresses the price too quickly and limits their ability to exit smoothly. Instead, they prefer to sell into strength, into your excitement, your FOMO, your belief that the market is about to take off. And how do they create that environment? By allowing the price to rise sharply, typically by stepping back slightly from the offer so buyers push price upward aggressively. The public interprets the rising prices as strength, and the composite operator uses the demand to complete their selling campaigns. This is why climactic volume at the highs is often such a powerful warning. The market appears strong, but it is strong only in appearance. Inside the tape, inside the character of the price bars, and the relationship between volume and spread, the story is different. A climactic surge may exhibit wide price spreads, huge volume, and strong upward closes, but the real clue lies in the closing positions and the follow-through. Frequently, after such a surge, the next bar fails to continue upward. It may even close poorly or show a narrower spread despite equally heavy volume. This signals that supply is stepping in aggressively, meeting all that buying with substantial selling. The inexperienced trader rarely sees this. They are too caught up in the emotion of the moment. They believe they are witnessing the beginning of something bigger, not the end of something mature. And this mindset becomes a costly pattern over time. They chase these climactic moves repeatedly, buying excitement instead of structure, enthusiasm instead of logic. They never question why volume has suddenly exploded, or whether the demand they think they see might actually be the effort of the public, not the intention of professionals. If you examine climactic volume carefully, you'll notice something subtle but important. This kind of volume tends to appear after a long advance, not at the beginning of one. Strong trends rarely start with climaxes, They start with accumulation, steady buying, and controlled upward progress. Climaxes come at the end, when the market has been moving upward long enough for the public to believe it cannot turn around. This is the emotional environment required for distribution to conclude successfully. Without widespread optimism, without fear of missing out, the composite operator cannot offload their large positions without negatively impacting price. From the perspective of trader psychology, climactic volume also reveals the mindset of the crowd. When a market surges upward after weeks or months of rising prices, the crowd concludes that the trend has been validated. They see confirmation, not exhaustion. They interpret the explosion in participation as a positive signal, not realizing that high volume at the top often means buyers are finally rushing in just as professionals are finishing their exits. The mental trap lies in assuming that high volume must always reflect strong demand. But in reality, volume only tells you that activity is increasing. It doesn't tell you who is responsible for that activity. That distinction is everything. Price closing off the highs after a climactic bar is another clue that the surge was not genuine strength. This kind of bar looks strong early in the session, but by the close, it shows clear signs of supply. The composite operator has absorbed all the demand they need, and now they begin to tighten the market. Once their distribution is complete, they no longer support the price. What follows can be a sharp reaction downward, an initial sign of weakness that many traders are unprepared for because they misread the earlier climactic behavior as bullish. Understanding this concept is not just about predicting tops. It's about training your mind to recognize the true nature of market strength and market weakness. It's about replacing emotional impulse with analytical observation. When you learn to read climactic volume correctly, you stop feeling the urgency to buy when everyone else is excited. You stop interpreting every large green bar as a signal to jump in. You begin to see the underlying intentions of the professionals, not just the surface level appearance of price movement. Climactic volume near the highs becomes your early warning light. It tells you that something is shifting beneath the surface, that the final stages of a trend may be unfolding, and that caution is more valuable than excitement. Wide spreads accompanied by heavy volume, but producing only minor upward progress, can be one of the clearest indications that distribution is unfolding, yet it is also one of the most misunderstood signals in all of trading. At first glance, such bars appear powerful, large candles, significant movement, plenty of activity. The average trader sees that kind of energy and immediately interprets it as bullish conviction. But when you look at the relationship between the spread, the volume, and the distance price actually travels, the story changes entirely. In the Wyckoff method, this combination is often the hallmark of hidden supply being unloaded into eager demand. To understand why, you must first consider what creates a wide spread on a price bar. A wide spread typically requires aggressive buying or aggressive selling, either side forcefully pushing price. When buyers are dominant, price expands upward with ease. When sellers are dominant, price drops without resistance. But when both forces are active at the same time, especially near the highs, the spread can be wide because of the intensity of activity rather than the direction of intention. Heavy volume means business is being done. The question is, who is taking the other side of all that buying? This is where the concept of the composite operator becomes essential. Professionals don't simply dump massive positions all at once that would collapse the price and destroy their own exits. Instead, they use public enthusiasm as a mechanism to distribute. When a stock has rallied for a considerable period and optimism is widespread, the public tends to buy aggressively on any sign of renewed momentum. This aggressive buying is precisely what creates wide spreads on the chart. But if the resulting progress is limited, if the bar closes only slightly above its open or above the previous bar despite tremendous volume, it suggests that someone is absorbing that buying, and the only participants large enough to absorb such demand are the professional interests themselves. The inexperienced trader sees a wide green bar and assumes it signals strength. They marvel at the volume, the push, the energy. They think, look at all the buyers coming in. This must be the start of a bigger move. But the skilled Wyckoff trader asks a different question. If buyers are so enthusiastic, why didn't price travel farther? Why didn't the spread carry the price strongly into new territory? Where is the effortless movement that accompanies genuine demand? These questions reveal the real imbalance between what appears to be happening and what is truly taking place behind the scenes. When wide spreads fail to produce substantial progress, it means supply is present, and not just present, but active. Consider the mechanics of this situation. Every share a professional sells must be bought by someone else. The more they wish to sell, the more buying they need to attract. And how do they attract buying? By allowing and even encouraging upward movement. They step aside momentarily to create the illusion of strength, letting the public push the price up. As soon as those eager buyers step in, the composite operator quietly unloads inventory into their enthusiasm. This process creates large spreads because both sides are participating heavily, but it limits upward follow-through because supply is meeting demand bar for bar. Often, after such a bar appears, the next few bars provide even clearer evidence of what is happening. You may see a narrow spread up bar with equally heavy volume, a sign of increasing effort but diminishing results. Or you may see immediate hesitation, a poor close, or a lack of continuation. These are all signals that the wide spread was not the beginning of a new wave of demand, but rather the continuation of a distribution process already underway. Remember, true strength does not struggle. True strength advances smoothly, with expanding spreads and proportional volume, not a surge of effort that leads nowhere. Another key point is that this kind of action usually occurs near resistance levels, previous highs, or the upper boundary of a trading range. The public treats these areas as breakout zones, while the composite operator treats them as optimal selling zones. Traders who haven't studied market behavior deeply often think resistance is meant to break eventually, and when they see a wide up bar with huge volume, they assume the breakout is finally underway. But this is precisely the moment when the smart money distributes the most. They rely on the herd's excitement to mask their exits. They rely on the belief that volume confirms the move, even though the Wyckoff lens shows that volume only confirms activity, not intention. These wide, spread, high-volume bars with limited progress also reveal something profound about trader psychology. The public believes that more effort equals more reward. If buyers are pushing hard, they assume the move must be strong. But in markets, effort that produces little result is one of the clearest indications of opposition. It's like watching someone push against a heavy object. If they strain with great force but the object barely moves, you can immediately conclude they're facing resistance. The same concept applies to price and volume. Heavy effort with small reward means someone is pushing back. This understanding also transforms the trader's mindset. Instead of reacting emotionally to what looks like strength, the disciplined trader becomes curious. Instead of assuming that heavy volume is always bullish, they question the context. They observe the broader structure. Has the market already rallied significantly? Is the price near previous highs? Does the spread match the volume? Does the next bar confirm or contradict the supposed strength? These questions separate the mature trader from the impulsive one. Wide spreads on heavy volume with minimal progress become a warning light, a sign that distribution may be peaking, that supply is active, and that the move may be nearing exhaustion. Decreasing upward progress despite increasing volume is one of those signals in the market that most traders see every day yet rarely understand. On the surface, it seems contradictory. The volume is growing. There's more activity, more participation, more apparent enthusiasm. So the move should be gaining strength, right? But if you study market behavior through the Wyckoff lens, you quickly realize that effort without corresponding result is one of the clearest signs that something underneath the surface is shifting. Markets do not lie. They reveal their intentions through the relationship between effort and outcome. And when effort increases while outcome diminishes, it is almost always a sign that supply is entering the market. To understand why this signal matters so much, think about what healthy demand looks like. In a genuine uptrend led by strong hands, Professionals accumulating early and marking up the price later. The movement upward is orderly and efficient. You'll see volume increase steadily, but the spreads also widen naturally. Price pushes upward with ease. Each new rally extends farther than the last. There is no sense of heaviness, no struggle to make progress. This is the hallmark of demand in control. But when the trend matures, when the public grows more enthusiastic, and the early buyers begin to offload their positions, the tone changes. Volume may continue rising because more participants are becoming active, but price no longer responds with the same enthusiasm. Instead of strong upward bars that cover long distances, you begin to see shorter moves, narrower spreads, and weaker closes. And every time the stock tries to push higher, it advances less than before. This is the moment when traders who understand the Wyckoff method begin to pay close attention. If buyers were in full control, the increased effort would translate into expanding movement. The fact that it doesn't suggests that something is absorbing that effort. That something is supply, professionals quietly distributing their holdings into the growing demand from the public. The public, however, rarely sees this. They interpret rising volume as a sign of growing strength. They assume more buyers are stepping in, and they believe that increasing activity means the move is gaining momentum. But professionals think differently. They ask whether the result matches the effort. If price is only advancing a little, perhaps making minor new highs or even failing to do so, despite larger and larger bursts of volume, then the operators know the market is beginning to show fatigue. They see the footprints of distribution long before the crowd feels any concern. This pattern of diminishing progress is also a behavioral cue. In the early stages of a trend, the public is hesitant. They are uncertain, skeptical, cautious. That's when professionals accumulate because they know the best opportunities arise when few others are willing to act. But as the trend matures, confidence grows. The public begins to buy more aggressively, entering with larger size and greater conviction. That buying produces higher volume, but ironically, because supply has now returned to the market, the additional demand isn't enough to continue pushing price upward smoothly. The result is that strange combination of more effort and less movement. You might see a stock make a new high, but only by a fraction of a percent, and only after a surge of heavy volume. Or you may observe a rally attempt that seems powerful at first glance, but when you measure it against previous rallies, you notice it traveled less distance, took more time, or ended with a poor close. These are not coincidences. They are signals that demand is no longer dominant. In many cases, they mark the very beginning of distribution, the phase when the composite operator shifts from accumulation to unloading. Another important aspect of this signal is how it appears in context. You rarely see decreasing upward progress with increasing volume at the beginning of trends. It tends to occur after an extended move, near resistance, or at the upper boundary of a trading range. That context matters because the location helps you determine whether the increasing volume is supporting the continuation of the trend or signaling a potential turning point. When you see this divergence between effort and result near the highs, it is often an early warning that buyers are failing to take control despite their enthusiasm. From the standpoint of trader psychology, this signal is also deeply tied to impulse versus discipline. When volume rises, inexperienced traders feel a surge of excitement. They believe they are witnessing confirmation, but what they are really seeing is effort, not intention. They disregard the result. They fail to notice that the market, despite all the activity, is struggling to advance. The disciplined trader, however, takes the opposite perspective. They become more cautious, more observant, and more patient. They wait for the market to reveal whether the demand is genuine or whether the increased volume is simply the public buying what professionals are quietly selling. This pattern can persist for several sessions or even longer. Each rally appears weaker than the last, even though the volume continues to swell. The bars may look energetic, but the net progress is limited. You might even see repeated attempts to push above certain price levels, but the market keeps getting pushed back. This is where Wyckoff's concept of supply overcoming demand becomes visible. The professionals are no longer supporting the price. Instead, they are meeting the public's buying with steady selling. The public believes they are buying strength. In reality, they are absorbing the supply that professionals want to unload. Decreasing upward progress despite increasing volume is thus a critical signal for identifying market shifts long before they become obvious. It helps traders avoid buying into the late stages of a move, when the risk is highest and the reward is diminishing. It trains the eye to see not just the activity, but the meaning behind the activity. Heavy volume on minor rallies inside a trading range is one of the clearest signs that supply is becoming dominant, yet it's also one of the easiest for newer traders to ignore. They look at the range, see the sideways movement, and assume nothing meaningful is happening. But those quiet, looking ranges often contain the most important clues in the entire market cycle. The Wyckoff method teaches that distribution doesn't always appear dramatic or obvious. Many times it happens quietly, almost politely, inside a zone where price drifts up and down while most traders grow bored and lose interest. But if you pay attention to the character of the volume during those small rallies, you'll begin to see what the composite operator is actually doing. A minor rally inside a range, by definition, is not meant to look powerful. It's just a small lift in price, usually after a slight decline or after price touches the lower boundary of the range. And because it isn't explosive or dramatic, traders don't usually examine it closely. They figure these movements are noise. But look carefully at the volume behind those movements. If the market needs heavy volume just to produce a small upward push, that is a sign the rally is being met with significant supply. This means someone is selling into that strength, and minor rallies are the perfect place for the composite operator to sell quietly without attracting too much attention. Think about what a healthy rally should look like. When demand is strong and professionals are supporting the price, the market does not need huge volume to lift. It rises easily, with clean spreads and smooth progress. Even inside a range, the rallies tend to look effortless when accumulation is taking place. But when the market requires increasingly heavy volume to make even a small upward movement, that tells you the effort is large but the result is small. In Wyckoff's language, effort versus result is everything. If the effort is large and the result is small, then you know supply is active. Now consider the psychology of traders inside a range. The public gets confused during these phases. They don't see a clear direction, so their conviction weakens. This is exactly the environment the composite operator wants during distribution. They don't want the public too excited yet. They want them uncertain, but still willing to buy small dips or attempt small breakouts. In this state of uncertainty, many traders see the little rallies as harmless. They believe nothing big is happening until the breakout actually comes. Meanwhile, professionals are using those very same rallies to unload inventory gradually. This is why heavy volume on these small rallies is such a meaningful clue. It shows that someone is providing supply every time the price attempts to rise. The market is trying to move up, but it feels heavy. The tape doesn't breathe easily. Each rally becomes a kind of struggle, a fight rather than a natural move. And fights inside a range usually mean distribution, not accumulation. One of the most revealing features of this behavior is how consistent it can be. You may see a minor rally from the middle of the range that produces almost no progress but uses large volume. A few sessions later, another rally begins, again requiring heavy volume and producing only a fraction of upward movement. These repeated signs indicate that supply is not only present but persistent. Someone with size is selling. They are not waiting for a breakout. They are using the imbalance of the range to disguise their distribution. The public, however, often interprets these rallies as strength returning to the market. They see the green bars and the volume spikes and think, maybe the breakout is coming. But the Wyckoff trader asks a very different question. If this is real strength, why does the rally feel so forced? Why does it take so much activity to lift the price such a short distance? Real strength doesn't need to strain. It moves like water flowing downhill. Distribution moves like someone walking with weights tied to their feet, slow, heavy, restricted. Another important detail is where these heavy volume minor rallies occur. If they happen after a preliminary sign of weakness, the signal becomes even more meaningful. A minor rally on heavy volume after the market has already shown signs of stress suggests the buyers are trying to lift the price, but the supply is overwhelming them. The strength isn't real, it's a reaction. And reactions are often the composite operator's favorite place to sell. Imagine a typical range. Price drops to the lower boundary and bounces. It rallies slightly, but the rally is weak. The spreads are narrow, the closes are unimpressive, and the volume spikes unnaturally high. To the Wyckoff trader, this says the move is not driven by demand but by short covering, bargain hunters, and the public testing the waters, while professionals use the moment to continue lightening their positions. This pattern teaches you something fundamental about the market's internal struggle. Demand is trying, but supply is responding. Demand pushes up, but supply pushes back harder. The imbalance becomes visible not in big movements, but in the small ones. Those small rallies are like pressure tests. The composite operator watches how the public reacts to them, how much volume it takes to lift the price, how far price can travel with that effort, and how quickly the rally loses momentum. When the effort keeps increasing but the upward movement keeps shrinking, the story becomes clear. The market is preparing for a shift. Distribution is taking place, and traders who pay attention to these details avoid the trap of buying into a coming markdown just because price has temporarily lifted within the range. An upthrust is one of the market's most deceptive maneuvers, and it is designed for one purpose: to draw the public into buying at precisely the wrong moment. It looks like a breakout, feels like a breakout, and triggers the same emotional excitement that breakouts always trigger: hope, urgency, and fear of missing out. But to the Wyckoff trader, an upthrust above resistance is not a sign of strength. It is a test, a trap, a calculated move by the composite operator to see how much demand is left and to use that final burst of enthusiasm to unload inventory onto unprepared buyers. To understand why an upthrust is so powerful as a distribution signal, you first have to understand how breakouts are perceived by the general trading public. Most traders are conditioned to chase new highs. They're told that breakouts are reliable, that momentum is safe, and that buying strength is the smart move. So when price pushes above a well-watched resistance level, the public rushes in. They assume the market is finally ready to run. They assume demand is overwhelming. They assume missing the breakout would be a mistake. This emotional pressure makes them easy to manipulate. But the composite operator thinks differently. He has no interest in buying at the top. He is interested in selling there. When price approaches resistance, his goal is to gauge the market's appetite. How many buyers remain? How desperate are they? How aggressively will they chase? The upthrust is the perfect tool for this. Price is allowed to break just above resistance, just enough to trigger stop-ins, breakout buys, and emotional entries from the crowd. Volume expands as the public piles in, but the smart money is selling into their excitement. This is why the upthrust often forms a long upper wick. Price pushes above the resistance zone but quickly fails to hold. The next bar may close back inside the range. Sometimes the reversal is immediate, almost violent. Other times it is subtle, a failed continuation, a sluggish response, a heavy close. Regardless of the form, the important thing is the behavior. Price could not remain above the breakout level because there was not enough true demand to support it. What looked like strength was actually supply. The public, of course, rarely sees this coming. They interpret the breakout as confirmation. They think they're acting logically, but they're acting emotionally. The Wyckoff trader sees something very different, a deliberate test of demand. If the breakout had real demand behind it, the price would hold above the level, or at least consolidate healthily. Instead, price snaps back, it sinks, it hesitates. It shows that the breakout was nothing more than an illusion created by the composite operator to satisfy the last wave of buying interest. This failure is incredibly meaningful. In Wyckoff analysis, a market that cannot hold above resistance after a push upward is telegraphing weakness. It's signaling that supply is greater than demand at those levels. It's revealing that the professionals have completed a major portion of their distribution. And once distribution is complete, the market no longer needs to be supported. The markdown phase is not far away. Another aspect of the upthrust that makes it so dangerous for the public is how convincing it feels in real time. Breakouts in general are emotional triggers. Traders think they are catching the next big move. They fear being left out. They imagine all the potential upside, but they forget to ask the most important question. If this is real strength, why is the breakout so dramatic? Why is the move so explosive? Why is the candle so large? Real strength doesn't need to exaggerate. It moves steadily, confidently, without theatrics. Upthrusts, on the other hand, are full of theatrics. Notice also how volume behaves during an upthrust. It often spikes dramatically. The inexperienced trader sees high volume and assumes it confirms the breakout, but volume doesn't confirm direction. It only confirms activity, and in an upthrust, the activity is frequently dominated by supply. The composite operator is offloading inventory while the public is frantically buying. So the heavy volume isn't bullish. It's the last gasp of demand before the structure begins to weaken. Once you learn to recognize this pattern, your perspective changes. Instead of feeling excited when price bursts above resistance, you feel cautious. You ask whether the breakout is supported. You look for the close, the continuation, the reaction. You examine whether the upthrust is a true breakout or simply a trap. This shift in thinking transforms your entire approach to the market. It keeps you from buying tops. It helps you understand where professionals are active. It allows you to anticipate weakness before it becomes obvious. The upthrust is also a psychological mirror. It exposes the trader's mindset. Those who act impulsively get caught. Those who act emotionally get trapped. But those who observe with patience, who understand behavior, who study effort versus result, they begin to see through the illusion. They recognize that upthrusts exist because the crowd is predictable. The composite operator uses the same tactic over and over because it works again and again. Inside a trading range, the upthrust becomes even more important. It marks the upper boundary of distribution. It shows that professionals are no longer interested in supporting the price. It signals that the structure is closing out, that the conditions for markdown are forming. The small failures after the upthrust, the lower highs, the weaker rallies, the heavy volume on declines, all begin to tell a story of supply taking control, a story of demand drying up, a story of a market preparing to shift direction. And when you read that story through the lens of the Wyckoff method, you no longer see a breakout, you see a test.